about 6 months ago, we announced a spin-off of a new company called Curbline that will be spun off in the fourth quarter from Site Centers, and that business is to grow by buying assets, particularly small retail assets that are convenient-oriented. We've been very active in purchasing those types of properties.
Joining me today is David Lukes, President and CEO of Site Centers Corporation. So David, to what extent is Site Centers seeing acquisition opportunities or the chance to dispose of properties in the current market?
Well, normally, Sarah, and thanks for having me, normally I'd say that answer would be very quick and that we were finding a couple of things here and there, but about 6 months ago we announced a spin-off of a new company called Curbline that will be spun off in the fourth quarter from Site Centers, and that business is to grow by buying assets, particularly small retail assets that are convenient-oriented. We've been very active in purchasing those types of properties. We just had a press release go out on Monday that suggested that we have almost $200 million of deals that are kind of moving towards contract to buy. And to fund those and to make the spin take place, we're also selling a lot. And in that same press release, if you quantify the aggregate amount of assets that we have been selling, we've got a little over $2.5 billion of properties that we've either sold, we're under contract, or we've awarded to buyers in the last 6 or 8 months. So we've got a lot of transaction activity happening right now.
Right, so it's a very active market.
Extremely active market right now. Matter of fact, in all the years I've been in retail, this year is the most transactions I've seen take place in a very long time.
Interesting. Can you point to an aspect of your latest earnings report that you feel especially highlights your broader strategy?
Yeah, I think if I go back to our spin-off announcement, strategically speaking, retail is in a euphoric moment right now. Tenant demand is very high. There's very little space left on the market. Rents are growing. Tenants came out of COVID very strong and looking for space. But from our perspective, to differentiate ourselves, this new strategy of buying smaller properties with smaller tenants is really around one fundamental issue, and that is there's more tenants that will take smaller spaces, and the landlord contribution of capital, or CapEx, to generate growth in those properties is much lower than a traditional format open-air shopping center. So our strategy is consistent growth over time with much less landlord capital, and I think that's going to be a winning strategy in an environment where the cost of capital is higher than it was a few years ago.
And what do you expect to be prioritizing at Site Centers over the short to medium term?
It's the short and medium term for us is very tactical. We have 2 companies that will be operated by the same group of employees. We have a shared service agreement which will have to operate both of those companies. We've got a lot of tactical nuts and bolts things going on between buying and selling. I mean, for a company of our size to transact in $2.5 to $3 billion in 12 months is a lot of work. And so I would say that the nuts and bolts of running the business is definitely taking the majority of the time in the near term.